Good morning, everyone, and thank you for joining us today. As I said in March, it is an honour to be CEO of Smiths. This is a great company, doing many outstanding things. As you'll see, the business is in a strong position, delivering good results. I'll start with some initial thoughts and a short recap of our FY 2024 performance before turning it over to Claire to walk us through the numbers. I'll then come back and update you on how I view our strategy and outlook, and we'll have plenty of time at the end for Q&A. As many of you know, I've been at Smiths for well over 30 years, and during that time I've had the privilege to run several of our businesses. This has given me a deep appreciation of the group's impressive attributes that have seasoned over time. Smiths is a portfolio of market-leading businesses and has many strengths: talented people, many of them with world-class engineering expertise, differentiated proprietary technology, and strong brands. We're well positioned in attractive markets that offer significant opportunity for profitable growth, and we're helping our customers to make the world safer, more energy efficient and productive, and better connected. A great foundation, and I firmly believe that we are well placed to create more value in the future. We have diverse and immense talent in the company, and we're committed to nurturing, supporting, and developing this most precious of resources. I've always and continue to see my role as creating value for shareholders, customers, and colleagues. And indeed, I have benefited from my experience across different businesses and regions, developing and sharing best practice. I intend to ensure that more of our people have similar development opportunities. In addition, our commitment to safety, engagement and inclusion, talent development, and sustainability will continue to strengthen our culture. Although our business is strong, there's always more to do, from delivering improved performance in partnership with our customers and suppliers, to sharing best practice across the group, and inspiring and empowering our people. Each business has a clear roadmap to improve profitability and enhance capabilities. This will take time, and although we're not looking at a radical reset, there are a number of initiatives which will drive improvements centered around our acceleration plan. I look forward to sharing these with you today and updating you regularly as we deliver. To be clear, this plan is about value creation, not just transformation. So we will optimize footprint to support customers, as well as invest to enable our processes to scale efficiently as we grow. We propose to invest approximately £60 to £65 million over the next 2 years and deliver £30 to £35 million of annualised savings by FY27. I will also outline where I think we can improve things to achieve further growth and drive our margins sustainably to deliver the medium-term financial targets we've set and which I reaffirm today. With that, let me turn to the results. I'm pleased to report we have continued to have a robust delivery against our strategy, with a good operational and financial performance. Both organic revenue growth and operating margin were in line with our guidance. Our cash flow conversion has improved, and we've deployed cash into organic R&D investment and into M&A. This morning, we are pleased to announce 2 acquisitions which will be integrated into Flex-Tek, enhancing its HVAC and industrial heating platforms. Our balance sheet remains strong to support our continued growth strategy. Overall, we're making good strategic, operational, and financial progress. So looking beyond next year, we have reaffirmed our medium-term targets. Our focused strategy and leading businesses mean that we are well positioned to create value for all our stakeholders. The opportunities ahead are significant, and we look forward to executing on them. With that, I will now turn it over to Claire to walk you through the financial results.
Thank you, Roland, and good morning, everyone. Organic revenue growth for the year was 5.4%. Acquisitions added 2%, and there was a negative 4.3% FX impact, bringing reported growth to 3.1%. We increased operating profit to $526 million, up 7.1% organically. Importantly, we continued investing for the future and at the same time improved operating margin by 30 basis points. Operating profit, acquisitions, and our share buyback activity contributed to constant currency EPS growth of 12.9%. Including the impact of FX, our basic EPS growth was 8.3%. We also increased operating cash conversion by 11 percentage points to 97%. And ROCE was up 70 basis points to 16.4%, driven by increased profitability. Finally, in line with our progressive dividend policy, we're recommending a final dividend of 30.2 pence, resulting in a total full-year dividend of 43.75 pence, a 5.2% increase. Turning to results in more detail and starting with organic revenue growth. We continue to extend our track record of growth and are pleased to report our third consecutive year of organic revenue growth, building on FY23's record organic growth. We converted revenue growth into 7.1% organic operating profit growth. Pricing more than offset inflation, contributing 50 basis points of margin expansion. With respect to volume, John Crane and Detection volume drove 60 basis points of margin expansion, of which 40 basis points was offset by volume declines in Flex-Tek and Interconnect. Mix also reduced margin by 40 basis points. And finally, consistent with our philosophy of saving where we can in order to invest where we want, we invested in several growth initiatives. These were funded by benefits from SES and other savings projects. So in summary, we delivered a 16.8% operating profit margin and a 30 basis point expansion in line with our guidance for continued margin improvement. For the year, the primary drivers of EPS were growth in operating profit, our accretive acquisition of heating and cooling products, or HCP, and the benefit of our share buyback activity. On a constant currency basis, we delivered 12.9% EPS growth, and including the impact of FX, our reported EPS growth was 8.3%. We delivered an 11 percentage point increase in operating cash conversion to 97%. This reflects both a tailwind from disciplined working capital management as well as a headwind from increased CapEx supporting capacity expansion and automation investment in John Crane. John Crane's machining upgrade program started in FY24, but it's largely weighted toward and will complete in FY25. Therefore, at the group level for FY25, we anticipate spending approximately $110 million in CapEx. In addition to our normal CapEx, FY25's higher than usual spend will cover the completion of the John Crane Efficiency Investment Program, which I just mentioned, as well as some additional CapEx initiatives that Roland will speak to later, all of which will support continued profitable growth. And we anticipate returning to recent trend levels of CapEx in FY26. Finally, this year's $509 million of operating cash converted to $298 million of free cash flow, a notable 67% year-on-year increase. Now turning to each of our divisions and starting with John Crane. John Crane delivered organic revenue growth of 9.8%, with an exceptional performance in the first half before moderating to strong growth as expected in the second half. Growth was led by energy, especially in aftermarket sales and notably in the Middle East and Latin America. This revenue growth translated into strong operating profit growth and 60 basis points of organic margin expansion due to good operating leverage, disciplined pricing, and SES benefits, which more than offset cost inflation and mix. John Crane delivered this margin expansion while continuing to invest for future growth, including hiring additional sales reps and service engineers. Given our ability to help customers improve efficiency and reduce emissions from their operations, we had notable wins across the world, from Kazakhstan to Canada. John Crane's energy diversification pipeline also continues to expand, and we're now actively pursuing around 125 carbon capture and hydrogen projects. Finally, our strong recent order intake growth supports our positive outlook for FY25. The Smiths Excellence System, or SES, also underpins our outlook. At our John Crane Deep Dive event last November, we spoke about how we're using SES, lean, and automation to improve efficiency and customer responsiveness. As just one example, we previously invested in machine data capture in John Crane's Czech plant. This enabled us to analyze and optimize machine utilization, operator productivity, and scheduling, as well as shop floor layout at that location. We then invested in and rolled out those learnings to another 9 John Crane locations across 7 countries. We've also centralized and standardized our programming in India. So in summary, using our SES framework to apply lean principles to automation across key value streams has driven both efficiency and cost improvements in our John Crane operations and enables us to rapidly respond to customer demand in FY25 and beyond. Detection also executed on a strong order book and delivered organic revenue growth of 11.1%, with growth in both segments. In aviation, OE sales increased 25%, reflecting strong demand for our CT airport checkpoint scanners, with multiple new wins across the globe, including the US, the UK, South Korea, Saudi Arabia, New Zealand, and Germany. And we estimate that globally, the current checkpoint upgrade is about 45% of the way through. So good demand should continue for the next roughly 3 years. Of note, our win rate to date on CTIX tenders remains above 50%. And importantly, the OE sales we secure come with an attractive aftermarket that we expect to continue to add to margin expansion over the medium term. 2.6% organic revenue growth in other security systems reflects a strong performance in defense and urban security, partially offset by weaker ports and borders. As a reminder, in FY24, we received an initial $88 million multi-year contract from the UK Ministry of Defence for next-generation chemical detection equipment. Operating profit grew 18%, and margin expanded by 70 basis points. This reflects higher volumes and improving operational efficiency in the second half, even including Detection's continued investment in field service engineers to support record installation activity. Order intake growth in the year was exceptionally strong, and we ended the year with a record order book that will support growth in FY25 and beyond. This anticipated growth, ongoing SES activities, and increasing defense and aftermarket revenue underpin our expectation for continued margin expansion in the coming years. In detection, we have a heritage of innovating to meet the world's evolving security needs. And most recently, we pre-launched X-ray diffraction at the Frankfurt Passenger Terminal Expo in April. We're now working closely with regulators to gain necessary certifications. And in parallel, we're educating a range of hold baggage customers on the merits of this new technology. We expect to achieve modest first orders for this product in FY25, with associated revenue coming through in FY26 and beyond. Here's a short video which brings diffraction to life.
X-ray screening is one of the most effective and efficient technologies used at airports, ports and borders, and other critical infrastructure to ensure the safety of people and goods and detect contraband. There are 3 different key X-ray techniques: transmission X-ray, computer tomography, and X-ray diffraction. Conventional X-ray and CT technologies both analyze the absorption of X-rays by the scanned item to differentiate materials and reflect the result in X-ray images. Conventional X-ray scanners create 2D images from fixed generators and detectors. CT scanners rotate the generator and detector around the item and reconstruct hundreds of views into 3D images. X-ray diffraction uses a different approach. It measures how the X-rays interfere with the molecular structure of the scanned item. As X-ray diffraction can even differentiate between materials with very similar densities, it's ideal for compounds such as improvised explosives and narcotics, in powder, liquid, or solid forms.
As you've just seen, X-ray diffraction provides significantly enhanced detection accuracy within a hold baggage screening operation. It reduces the number of false alarms, which are time-consuming to resolve, and so improves efficiency. Although designed for aviation hold baggage, we're exploring the potential of diffraction with other commercial customers, such as cargo operators and customs agencies. A great example of innovation at Smiths. And now turning to FlexTech. Revenue declined 0.8% organically, with an improved second half performance when we returned to growth as we guided. FlexTech's industrial segment declined 3.5% as expected, mainly in HVAC and reflecting extended softness in U.S. construction. Partially offsetting this, aerospace sales grew almost 11%, linked to new aircraft builds. Despite overall lower sales, organic operating profit increased 4.2%, and FlexTech expanded operating margins by 100 basis points. Margin expansion was driven by exceptional cost control in light of lower volumes and a positive mix impact from industrial heating contracts. In addition, the integration of heating and cooling products, which we acquired in August of 2023, is running ahead of plan. Looking forward, the timing and shape of the U.S. housing recovery will be a key determinant for FlexTech in FY25. And we expect aerospace sales to remain strong, given they're underpinned by a healthy order book. Today in FlexTech, we're also pleased to announce 2 strategic and disciplined acquisitions for a combined purchase price of $95 million, plus up to an additional $15 million earnout tied to the performance for one of the acquisitions over the next 3 years. This combined purchase price represents an average trailing EBITDA multiple of roughly 8 times. These acquisitions enable us to meaningfully expand in 2 of FlexTech's core platforms, HVAC and industrial electric heating. Now a bit more about our acquisitions. First, Modular Metal Fabricators. Modular Metal is a metal and flexible ducting manufacturer which extends our HVAC presence in the western U.S. and broadens our product range to include their sealed flexible duct solution. This acquisition is similar to our August 2023 acquisition of HCP, which expanded our coverage in the Midwest and eastern U.S. We expect to complete this acquisition in October. And second, Wattco. The acquisition of Wattco enables FlexTech to expand into medium temperature, immersion, and circulation heating, an attractive market adjacency which is highly complementary to our existing open coil electric heating business. We've already completed this acquisition. Both acquisitions have been on our radar for some time and are family-owned businesses which we acquired in bilateral discussions. Clear evidence that our acquisition targeting and cultivation is working, and we're well positioned to continue to advance an active pipeline of attractive opportunities. Turning now to Smiths Interconnect. where organic revenue declined 6.5% as a result of weakness in connectors and the semi-test market. Like FlexTech, Interconnect's second half performance improved and posted marginal organic growth. Reflecting lower volumes, organic operating profit declined by 17.8% and operating margin contracted 190 basis points. The team in Interconnect diligently managed costs while also maintaining R&D investment to support our new product launches and longer-term new product pipeline. So we're well positioned for an improving market backdrop. Our order activity improved sequentially throughout the year, especially for our semi-test products. This, together with our new product pipeline, underpin our expectation for performance improvement in semi-test and aerospace and defense programs as we progress through FY25. On the left-hand side of this page is an example of one of Interconnect's new products, the Da Vinci 112 test socket within our semi-test business. It's used by leading AI and data center semiconductor manufacturers to test high-speed and complex circuits. It eliminates false faults and functional failures, so our customers can benefit from increased production yields and throughput. On the right-hand side, we're also a market leader in space-grade transceivers, and we have a strong order book in this product family as well. A good example of innovation here is the recent launch of the Mini-Lock connector, which offers superior radio frequency performance, is compact and lightweight, and is designed for harsh environments such as satellites and space and defense. Turning now to our capital allocation framework. Our priorities remain unchanged. We aim to fuel organic growth, pursue strategic and disciplined acquisitions, and have demonstrated our commitment to returning excess capital to shareholders. In support of organic growth in FY24, we invested $181 million in R&D and CapEx. Also, just discussed in FlexTech's divisional results, in FY24 we acquired HCP, and today we're announcing 2 strategic and disciplined acquisitions that enhance FlexTech's core capabilities. Our third priority is returning capital to our shareholders. Today, we're recommending a 5.2% increase in our final dividend in line with our progressive dividend policy. In FY24, we spent a total of $70 million on share buyback. This comprised the final $29 million from the group's 2021 share buyback program, plus $41 million from the initial $50 million tranche of the program we announced in March of this year. Post the year end, we completed the remaining $9 million of this first tranche. Given today's acquisition announcements, our active pipeline of potential acquisitions, and the acceleration plan, we've not yet initiated the second tranche. During FY24 and the start of FY25, we also sold the majority of our stake in ICU Medical, which raised $233 million in proceeds. In summary, our leverage at the fiscal year end was 0.3 times net debt to EBITDA. On a pro forma basis, taking into account the 2 acquisitions we're announcing today, the buybacks, and our ICU share sales, our pro forma leverage is 0.4 times. This balance sheet strength gives us the financial flexibility to execute our strategic and financial goals. Finally, a few words about our outlook for FY25. We're again expecting organic growth within our medium-term target range of 4 to 6%, reflecting continued strong demand and good order book visibility at John Crane, Smiths Detection, and FlexTech Aerospace, a recovery in U.S. construction for FlexTech, and recovery in semi-test and markets for Interconnect. We also expect continued margin expansion in FY25, reflecting operational leverage and continued benefits from the Smiths Excellence System and lean initiatives in particular. Roland will describe the timing and shape of the acceleration plan, which he introduced in his opening remarks and which we're initiating today. The acceleration plan will have minimal headline impact in FY25 as we take associated costs below the line, and benefits will begin to phase in during FY26. Regarding cash conversion, in FY25, we expect the full year to be in the low 90% and to be weighted toward the second half of the year. This reflects the timing of CapEx investments in John Crane efficiency, which I discussed earlier, and a small amount of CapEx that is part of the acceleration plan. In conclusion, we have positive momentum, clear execution priorities, and an energized team under Roland's leadership as we enter FY25. With that, let me hand back to Roland.
Thank you, Claire. As the new CEO, I realize that you're keen to know what's going to change and what will stay the same. So let me give you a quick overview now and then go into detail afterwards. My remit is simple: build on and out from our solid foundations, and to take the best of Smiths and to make it better. Our purpose and mission remain unchanged, as do the key components of our strategy, which are to deliver profitable growth from attractive markets, to invest in technology and engineering for competitive differentiation, and to implement often mission-critical solutions within long-term customer partnerships. As you'll recall, we group our priorities into 3 areas. These are broadly the same, but there are some important changes. We are